Did you know companies like Johnson & Johnson and Procter & Gamble have been paying and increasing their dividends for decades? What if I told you that you could leverage these dividends to earn $5,000 a month? Stick around as we explore the powerful world of dividend investing and reveal strategies that can help you achieve this goal. All right, let's start with the basics. So, what exactly are dividends? Simply put, dividends are payments made by a company to its shareholders, usually drawn from its profits. Think of it as a reward for investing in the company. These payments can be made in cash or additional shares of stock. Dividends are a great way to earn a steady income from your investments, and they can be a sign of a company's financial health. Companies that pay dividends are often well-established and financially stable. But why do companies pay dividends in the first place? Well, there are several reasons, and it often depends on the company's stage of growth and financial strategy. One reason is to share profits with shareholders. This is common among mature companies with stable earnings. For example, Microsoft has been paying dividends since 2003 and has consistently increased its dividend payments. In 2023, Microsoft paid an annual dividend of $2.72 per share. Another reason is to attract and retain investors. Dividends can make a company's stock more attractive, especially to income-focused investors. This increased demand can drive up the stock price. For instance, companies like ExxonMobil and Verizon are known for their attractive dividend yields, which help maintain a loyal investor base. Dividends also signal financial strength. A company that can consistently pay and increase dividends is often seen as financially healthy. This can boost investor confidence and support the stock price. For example, Procter & Gamble has increased its dividend for 67 consecutive years, showcasing its financial stability. We'd love to hear from you. What are your favorite dividend stocks? Drop your thoughts in the comments below. Now let's dive into some historical data on dividends. Understanding the past performance of dividend stocks can give us valuable insights into their potential future performance. Ready to see some real-life examples? All right, let's get started. Now that we've covered the basics of dividends and why companies pay them, let's look at some historical data. Understanding the past performance of dividend stocks can give us valuable insights into their potential future performance. Let's start with the S&P 500, a benchmark for the overall stock market. Historically, the S&P 500 has had an average dividend yield of around 2% to 3%. During the 2008 financial crisis, the yield spiked to over 3.5% as stock prices fell, but it has since stabilized around 2%. This shows how dividend yields can fluctuate with market conditions. Now let's look at some specific examples of dividend stocks. We'll start with Johnson & Johnson, a company that has been paying dividends for over 50 years. In 2023, J&J paid an annual dividend of $4.52 per share. If you owned 100 shares, you would have received $452 in dividends for the year. Another great example is Procter & Gamble. This company has been paying dividends for over 130 years and increased its dividend for the 67th consecutive year in 2023. PG paid an annual dividend of $3.65 per share. If you owned 200 shares, you would have received $730 in dividends for the year. Let's look at some effective dividend strategies. These strategies can help you build a robust portfolio that generates consistent income. We'll cover three main strategies: dividend growth investing, high-yield dividend investing, and dividend aristocrats. This strategy focuses on companies that consistently increase their dividends over time. The idea is to invest in companies with a strong track record of dividend growth, which can lead to higher income over the long term. For example, Johnson & Johnson has increased its dividend for 61 consecutive years. In 2023, J&J paid an annual dividend of $4.52 per share, up from $4.24 in 2022. This consistent growth can significantly boost your income over time. Another great example is Procter & Gamble, which has increased its dividend for 67 consecutive years. In 2023, PG paid an annual dividend of $3.65 per share, share, up from $3.48 in 2022. These companies are known as Dividend Aristocrats, and we'll talk more about them later. Next up, let's dive into high-yield dividend investing. This strategy focuses on stocks with high dividend yields, meaning they pay a large percentage of their profits as dividends. While this can provide substantial income, it's important to balance yield with stability to manage risk. For example, AT&T had a dividend yield of around 7% in 2023, paying an annual dividend of $1.11 per share. If you owned 500 shares, you would have received $555 in dividends for the year. Another example is Altria, which had a dividend yield of about 8%, paying an annual dividend of $3.76 per share. If you owned 200 shares, you would have received $752 in dividends for the year. High-yield stocks can significantly boost your income, but they also come with higher risks. For instance, companies with very high yields might be facing financial difficulties or might not sustain their dividend payments. It's crucial to research the company's financial health and dividend history. A good strategy is to look for companies with a strong balance sheet and consistent earnings. For example, Verizon had a dividend yield of around 6.5% in 2023, paying an annual dividend of $2.61 per share. Verizon has a solid financial foundation, making it a more stable, high-yield option. Another tip is to diversify your high-yield investments across different sectors. This reduces the risk of sector-specific downturns affecting your entire portfolio. For instance, you might invest in high-yield stocks from sectors like telecommunications, utilities, and consumer staples. All right, now let's talk about Dividend Aristocrats. These are companies that have increased their dividends for at least 25 consecutive years. Investing in Dividend Aristocrats can provide a reliable and growing income stream. Some examples include Coca-Cola, which has increased its dividend for 61 consecutive years, and McDonald's with 47 years of dividend increases. These companies are often leaders in their industries and have strong financials. The S&P 500 Dividend Aristocrats Index measures the performance of these companies. Historically, this index has outperformed the broader market. For instance, from 2010 to 2020, the Dividend Aristocrats Index has an annualized return of 12.9% compared to 11.2% for the S&P 500. This shows the potential for both income and capital appreciation. Dividend Aristocrats are known for their stability and reliability. By investing in these companies, you can build a portfolio that provides consistent and growing income over time. For example, Johnson & Johnson and Procter & Gamble are both Dividend Aristocrats with a long history of dividend growth. In summary, Dividend Aristocrats offer a reliable and growing income stream. These companies have a proven track record of increasing dividends, making them a solid force for long-term investors. All right, let's break down how you can build a dividend portfolio to earn $5,000 a month. You'll go through 5 key steps to help you achieve this goal. First, determine your target yield. The target yield is the average dividend yield you aim to achieve with your portfolio. For a $5K a month goal, you'll need $60,000 a year. If you target an average yield of 4%, you'll need an investment of $1.5 million. This might seem like a lot, but with the right strategy and patience, it's achievable. It's important to set a realistic target yield. While higher yields can provide more income, they often come with higher risks. A balanced approach with a target yield of around 4% is a good starting point for most investors. Next, let's calculate the required investment. As mentioned, $5,000 a month equals $60,000 a year. With a 4% yield, you'll need $1.5 million invested. This calculation helps you set a clear goal and understand the scale of investment needed. It's important to remember that this is a long-term goal. You don't need to have $1.5 million right away. You can build your portfolio over time through regular investments and reinvesting dividends. For example, if you start with $100,000 and add $10,000 each year with an average annual return of 7%, including dividends, you could reach your $1.5 million goal in about 25 years. The key is consistency and patience. Now, diversify diversification is crucial. Spread your investments across different sectors to reduce risk and ensure a steady income stream. Some suggested sectors include utilities, consumer staples, financials, and real estate investment trusts. For example, the utility sector typically has an average dividend yield of around 3.5% to 4%. Consumer staples, which includes companies like Procter & Gamble, often yield around 2.5 to 3%. Financials such as banks and insurance companies can offer yields between 2 and 4%, and REITs are known for their high yields, often ranging from 4 to 6%. Reinvesting dividends or using dividend reinvestment plans can accelerate your portfolio's growth. By investing, you buy more shares, which leads to more dividends. This compounding effect can significantly boost your income over time. For example, if you invest $10,000 in a stock with a 4% dividend yield, you'll receive $400 in dividends in the first year. If you invest these dividends, your investment grows to $10,400. The next year, you'll earn dividends on $10,400, not just $10,000. Over 10 years, this compounding effect can significantly increase your investment. Let's say you start with $100,000 and reinvest all dividends. With an average annual return of 7%, including dividends, your investment could grow to over $196,000 in 10 years. This shows the power of compounding through dividend reinvestment. As with any investment strategy, dividend investing comes with its own set of risks. It's important to understand these risks and know how to mitigate them to protect your portfolio and ensure a steady income stream. First, let's talk about market risk. Stock prices can fluctuate due to various factors, including economic conditions, interest rates, and market sentiment. For example, during the 2008 financial crisis, the S&P 500 dropped by over 50%, significantly impacting dividend stocks. Next, we have the risk of dividend cuts. Companies may reduce or eliminate dividends if they face financial difficulties. For example, during the COVID-19 pandemic, many companies, including Disney, suspended their dividends to conserve cash. Inflation risk is another important consideration. Inflation can erode the purchasing power of your dividend income. For example, if inflation is 3% and your dividend yield is 4%, your real return is only 1%. To summarize, here are some key strategies to mitigate the risks associated with dividend investing. Diversify across sectors and industries. Spread your investments to reduce the impact of sector-specific downturns. Focus on companies with strong cash flows and low payout ratios. These companies are more likely to maintain their dividends during tough times. Invest in dividend growth stocks. These stocks can help your income keep pace with inflation. Regularly review and adjust your portfolio. Stay informed about the financial health of the companies in your portfolio and be prepared to make adjustments as needed. In conclusion, dividend investing can be a powerful strategy to generate a steady income stream. By understanding the potential risks and implementing effective mitigation strategies, you can build a robust portfolio that helps you achieve your financial goals. And we'd love to hear from you. So what are your favorite dividend stocks? Have you tried any of the strategies we've discussed? Drop your thoughts in the comments below. For more insights on building wealth, check out our recommended video, Dave Ramsey, Millennial's Path to Becoming a Millionaire. In this video, you'll learn about Dave Ramsey's principles for becoming a millionaire, including financial survival on a low income and extreme frugality strategies. It's packed with valuable tips that can help you on your financial journey. Click to watch and start your path to financial freedom.